This is chapter 14, video 2. Let's launch. Greetings, everybody. So now we're going to talk about rental properties. I love rental properties. I've got 3 of them myself, even though I'm going to sell a couple of them. We're looking at doing some really cool things for good stuff. So again, rental use of the home. There's going to be 3 classifications for the home. You have residents with minimal rental use, that's rented for 14 days or less. Residents with significant rental use, which is 15 days or more, and then you have non-residents. Okay, so if it's non-residents, basically it's going to be, like you rent it out, you basically use it for, you absolutely don't use it. Like, for example, all my rental properties, I haven't spent a single day in them since I left, since we moved out of the house. They're fully considered rental properties. Okay, so that's kind of the thing. Recall the definition from the beginning of the chapter. That's going to be kind of key to this. Again, we talked about that in the first video. I told you about that line that you're going to have. You've got the 2 T's that are kind of sticking up, but that line goes beyond them. So you have the area that's over here that's going to be personal use. So if I rent it out for 14 days or less, it's all personal use property. If I rent it out for or if I use it for less than 14 days, it's going to be considered a rental property. Anything in between is going to be considered a vacation property. I'll make that diagram when we do this in class. That way you guys can see this, and we can kind of get to that. Okay, so residents with minimal rental use. In other words, if you live in it for 14, if you must live in the home for at least 15 days and rent it out for 14 days or lower. Generally, I think the biggest example of this, and I've talked about this in class. Say you have a house, or say you have an apartment. It's in downtown DC in the Navy Yard, and the Nationals are going to go to the World Series. And you are not a baseball fan, but somebody comes to you and says, "Hey, if you let me borrow your apartment, or let me rent your apartment out for say $15,000 for myself and 2 of my friends." Well, yeah, rent it out, stock it with food and all that sort of stuff. We'll rent it for $15,000 so that we can go to the World Series. We can be there for a couple weeks and blah, blah, blah. You can do that. All income is tax-free. Let me repeat that. All income is tax-free. Okay? This is one of the few times where you can get rental income that is completely tax-free. Now, does that mean that you should buy a house next to every Super Bowl venue and go ahead and get ready to rent it out? Probably not a good business idea. Trust me, if it was, somebody else would be doing it. But again, if you have your house, you don't want to deal with the stuff, you can let your friends use it. They pay you a whole bunch of money and you're like, okay, fine. We get it done. It's tax-free income. Okay. No rental expense deducted except for those that are itemized deductions. So, for example, while they're in the house, no, I can't write off the electricity. No, I can't write off all this other stuff. You just got a whole bunch of tax-free income. I think you just got a good deal. And part of the reason why the IRS does this, they don't want you to have to set up a Schedule E in order to be able to figure all this stuff out, blah, blah. 14 days or less. Obviously, you're not doing this as a business idea. You can do that. The rental income can be excluded. There are no expenses that are deducted. Again, you got a pretty good deal. Probably just need to go ahead and accept it and move on. All right, so if you have a residence with significant rental use and significant personal use, you will have what's called a vacation home. So for example, I own a home, we'll say in Deep Creek. I don't, I wish I did, but I don't. But say I buy a home in Deep Creek. And by buying that home, I go ahead and I say, look, we're gonna purchase the home, and we'll, I'll go up there once a year for a month, and then the rest of the time we're going to go ahead and we're going to rent it out during the entire time. What ends up happening is that I'll fall under the vacation rule. So the income that comes to me is definitely taxable. The expenses that's allocable to the period of time when it's being rented out is deductible, but any other time it's not. And so that's very important. Now, the good news is on the tax software, what'll happen is you'll put in you'll put in the mortgage interest, you'll put in the state taxes, And then you're going to have to, the system will actually calculate how many days did you rent it out, how many days did you use it for personal, and then it's going to do a calculation on the formula in order to figure it out. You don't have to do a whole lot of work with this, but the good news is it will put the rest on Schedule A as it's supposed to. Sometimes they'll have a software in the box that says, don't move this to Schedule A. Maybe I've got something else that we're doing with that. So there could be some potential benefits to doing that in other ways. But again, when you're talking about, all this vacation stuff, it is kind of nasty because with a rental property, you can go into negative and you can carry them over and over and over and over. Generally speaking, it's only certain expenses that you can carry forward into the future, and that's going to be very important. So again, expenses are allocated to personal use and non-deductible unless deducted under another provision. So for example, mortgage interest, maybe I use the vacation home as partially for my business. Then I get to go ahead and I can deduct that under my business tax returns, which could be useful. Generally, expenses are allocated based on the number of days used and for each activity. There is an exception for mortgage interest and property taxes, which can be allocated based on total days of the year. It's called the tax court method. And the reason why is because under the tax court or the Bolton method, they wanted to allocate it based on the entire year and say, look, I rented it out for this many years, the personal use was this many days, and then the tax court method basically says any other day that's done that way is considered rental period time. The IRS didn't like that. They fought it. Tax court shot them down. The IRS still tells you, look, we know we lost in tax court. We still want you to do it the way that we tell you to do it. Tax court says, no, that's not the case. Now, here's the thing. IRS can do whatever they want, but you must follow, you can follow the tax court if you want. Now, if you want to follow the IRS rule, maybe it makes better sense for your client. You can take a look at it and see how that works out. All right. If rental exceeds rental expenses, all rental expenses are fully deductible. If rental expenses exceed rental revenue, rental expenses are categorized as tier 1, 2, or 3. We'll talk about that. Tier 1 are fully deductible, even if deduction creates a loss. Tier 2 are deductible up to the excess of revenue over Tier 1. Excess Tier 2 expenses carry over to the subsequent year. Tier 3 are deductible up to the rental revenue over Tier 1 and Tier 2. Tier 3 expenses carry over to the subsequent year. So it is important to have these things categorized, and we'll kind of look at this. So Tier 1 expenses are going to be used to acquire tenants. So basically your advertising costs, mortgage interest, rental properties. All others except for depreciation is going to be Tier 2, and then Tier 3 is going to be your depreciation. Okay? Rental use is at least 1 day, and personal use is no more than the greater of 14 days or 10 days of rental use. This will be considered a rental property. In other words, it's non-residence. You don't live there. Now, if I have that nice house up in Deep Creek, I can go there for a week, and it can still be considered a rental property. Okay? I don't get to deduct the period of portion that's allocated to my 1 week, but it is something that I could do. Okay? Non-residents, okay, so taxpayer includes all income on and deducts all rental expenses. Basically, you run this like a business. I mean, there's certain limitations to that. It falls under what's called under Code Section 212 as opposed to Code Section 162, and some of the Code Section 263 applies to both the business and the rental property. But 162 is really kind of the ordinary necessary business expenses. 212 does the same thing, but they're basically saying, look, in 212 talks about it as expenses for production of income, which is kind of what this is, as opposed to a business expense, which is trade or business. Okay, so production of income falls under this. If the property is used even for a day of personal use, the expense must be allocated between rental and personal. I've kind of said that. Taxpayer is not allowed to deduct personal use portion of the mortgage interest because it doesn't qualify as a residence. That is correct. Okay, it is something that, and sometimes you have to explain that to a taxpayer if they don't like it. Personal use portion taxes are deductible from as itemized deductions. Now, you might say, well, why would they allow you to do that? And that's because state and local taxes are generally deductible because of the fact that it would be sort of a type of double taxation or a double penalty if you had to pay federal taxes on the same money that you also were forced to pay to the state. And the thing is, you don't have to have a mortgage, but you do have to pay taxes. And I think that's part of the reason why they do that. So losses are going to be generally considered to be passive activity losses. So PALs, as we sometimes call them, can only be deducted to the extent that they have passive income. We talked about this in class. We have the silos that can, we have siloing that can take place, but we also have the 3 income buckets. You have the active, passive, and portfolio income. That's actually very useful and in order to understand that. Now, again, with the if I have the $25,000 of rental real estate exception, if I make less than $150,000 a year, I may be able to take a deduction of part of my PALs. But I have to be an active participant in the property. Now, does that mean that I'm the one who's collecting rent? I mean, there's certain. It's not really binary. This is kind of where we kind of get into some of the murkiness of it. And again, a lot of it's facts and circumstances. Again, I think that the most important thing is to be able to take a look at this, look at the rules, and as you do more and more of these, you'll start to understand. No, that's definitely active, or no, this person has a property overseas. They haven't gone overseas. They haven't even called overseas. They're probably not active in it. Okay. And that's all I got to say about that. All right, so that's all I have to talk about when it comes to rental properties and rental residences and vacation properties and all that stuff. I hope you learned a lot, and if you have any questions, feel free to reach out to me, and I look forward to seeing you in the next class.